Welcome to our press briefing for the final quarterly review of 2020. I'm Jill Ford, the Head of Communications, and welcome to today's On the Record media conference for the quarterly review. With me today are Claudio Borio, Head of the Monetary and Economic Department, and Hyun Sung Shin, Economic Advisor and Head of Research, along with the authors of the quarterly review. And some are joining remotely and some are joining us here at the BIS in Basel, so bear with us as we make the connections. So before we begin, I'd like to reiterate that the comments from Mr. Borio and Mr. Shin are on the record, and we can answer questions at the end with the authors as well. So please address your questions in the first instance to Mr. Borio and Mr. Shin. The embargo will lift at 1 o'clock Central European time today. The data behind the graphs and the translations of the press release are also already now available on our embargo site. So Mr. Borio and Mr. Shin will give introductory remarks, and then we'll hand over to your questions. So I hand over to Claudio Borio.
Well, thank you very much. Good morning, and thanks for joining us. This quarterly review looks at market developments from early September to the end of November. During this period, the prices of risky assets rallied. The rally was triggered by news of a vaccine, optimism about business conditions, and continued policy support kept markets buoyant as monetary policy remained accommodative or eased further. In addition, the search for yield gained momentum, spurred by historically low interest rates. The amount of negative yielding debt securities reached no less than $17.5 trillion, on a par with the previous peak. A certain amount of daylight between risky asset valuations and economic prospects seems to persist. While markets moved in the right direction in response to brighter macroeconomic prospects, they rose close to or above pre-pandemic levels, when questions about overstretched valuations were already being asked. Financial conditions generally loosened. At the same time, a gap opened in the way that capital markets and banks were pricing credit risk. Corporate credit spreads in advanced economies continued to shrink, nearing pre-pandemic lows. By contrast, banks tightened lending standards somewhat. Investors' search for yield and the specifics of policy support appeared to be at work. A key development was the broad-based depreciation of the US dollar. The relative performance of emerging market currencies partly reflected structural features of the relevant economies. The appreciation was larger for those focused on technology or more deeply involved in manufacturing global value chains than for those focused on commodities. The overview includes two boxes that shed further light on developments. One explores how changes in the supply of bonds available to investors can explain the divergence between US and German 10-year government bond yields. The other examines the relationship between stock markets and US Treasuries, traditionally seen as safe haven assets. We note that the hedging effectiveness of bonds has weakened in recent years. Now I hand over to Hyun to outline the special features.
Issue of the quarterly review, and many of them shed light on some very topical and current questions. The piece by Hoffman and Park is about the relationship between the dollar and the tail risk in growth in emerging market economies. What they find is that a broad-based appreciation of the dollar is associated with slower growth in emerging markets, and it raises the tail risks for the growth outlook. Now, obviously, these findings cut both ways, and they're useful in understanding the recent risk-on environment for emerging markets in the current environment of the weaker dollar. The piece by Banerjee and Karubi is about survival and exits of firms in the face of an economic slowdown. It's obviously highly relevant right now as we transition from the liquidity to the solvency phase. of the pandemic-induced slowdown. What the authors find is that it's the flow variables that matter, like low earnings. Now, debt also matters, but it seems that it's the short-term debt that seems to have the biggest impact on firm exit. The piece by Boisset et al. Look into the historical experience on the resolution of large-scale banking distress. They find that acting earlier and in a broad-based fashion do best to head off recessions. The highlights piece this time round by Hardy and Takats confirms that international bank lending has been a bright spot in the slowdown, in that it has remained pretty resilient both in advanced and in emerging economies. These findings underline the fact that banks have been a source of strength in the recent crisis, very unlike what happened during the great financial crisis of 2008 and 9. The special feature by Alfonso et al. Focused on the exciting recent advances in retail payment systems in Latin America. They show that central banks have led these initiatives and are intended to tackle the challenges of financial inclusion and high costs of retail payment services. And finally, and not least, the feature by Kapp et al. Introduces a Markets Committee compendium on monetary policy operating procedures, and it provides a short primer on the nuts and bolts of monetary policy operations. And this piece comes with an online resource that lays out the cross-country differences in a systematic and interactive way. So let me hand it back over to Jill.
Thank you very much, Hyun. So to ask a question, you're probably used to it by now, but please either raise your hand or you can type your question to all panelists. And if you're joining us just by phone, you can email your question to press@bis.org. So over to you now with your questions, please. We'll take a look. So the first question is from Frank Siebelt. Your hand is raised. So Frank, please ask your question from Reuters.
Yes, hello, good morning, Mr. Borio. That's Frank Siebelt from Reuters. I have one question regarding your remarks on overstretched valuations in the financial markets. Could you explain a little bit more in which segments you see most of the risks associated with this?
Well, thank you. Thank you very much for the question. First of all, as you know, detecting overvaluations or overstretching is not that straightforward. But you have to look at a broad range of assets, not focus on individual assets. And regardless, I would say, of the precise degree of overstretching, the asset class that for us is the most important is that of corporate debt. That is because there the signs are more easily detectable, because as Hyun was saying, we are moving from the liquidity to the solvency phase of the crisis. We should be expecting more bankruptcies going forward, and yet credit spreads are quite low by historical standards. And indeed, while banks are pricing risk more carefully, we don't see the same in capital markets.
Thank you very much, Claudio. The next question comes from Jack Schickler and MLEX. Jack, you have your hand raised, so please call out your question.
Hi, your study refers to methods to slow banking distress and the lessons we can learn from this first phase of the crisis that happened in spring. Here in Europe anyway, policymakers are preparing for what you could call a second phase of the crisis as it feeds into the real economy, and how to help banks manage their non-performing loans, whether you should have bad banks to house those, and how to deal with banks that are failing or likely to fail. Does your research kind of give any indications of what kind of policy response will be helpful in those scenarios?
Well, thank you for the question. First of all, a key point to note is that the early response of the authorities to deal with the initial signs of distress in financial markets was extremely helpful, because it prevented the possible stress there to broaden further into the financial system. Second point is that I think, as was implicit in your question, on this occasion banks have been part of the solution and not part of the problem. They have been able to deal with the increased demand for credit, and that's largely thanks to the international financial reforms that took place post-crisis, which improved the capitalization of the banks. So early response, very good. Banks in an initially strong position. I think that augurs well for the future. As far as the specific measures that might need to be taken depending on the evolution of the crisis and the evolution of the strength of the banking system, that will depend very much on the specific situation.
Thank you very much, Claudio. So I don't see any other raised hands at the moment. So reminder, you can raise your hand, type your question into the chat, or also you can email press@bis.org. So we'll take a moment of pause while we wait for additional questions. Okay, we have a question from Mark Jones. Mark Jones from Reuters. If your hand raised, please ask your question. Mark, we have no audio from you at the moment. If you want, you can type the question in, if that helps, or we'll pause again and wait to see, can we hear you coming in on the audio?
Can you hear me now?
Yes, we can. Thanks, Mark.
Great. So you mentioned the amount of negative yielding debt in the market as well. Is that something that we should be concerned about too? And just obviously, as we look at this, we're talking about this growing amount of daylight between the market valuations and the economic outlook. How should central banks be going forward here in terms of their policies?
Thank you, Mark. I did not actually fully grasp your question. What did you say about debt? The amount of debt?
So you referred to the amount of negative yielding debt.
Yes.
Is that a level where it's potentially concerning, first of all, and then also how should central banks be thinking about themselves at the moment, considering we've got vaccines coming down the pipe?
Okay, thank you. Thank you for the question. The first point to note is indeed that the amount of negative yielding debt is close to previous peaks, and probably is not so much the amount of negative debt per se, but the amount of overall debt, which is at very low rates, which matters. Now, as far as the negative debt, put yourself in the shoes of an investor who is trying to get some yield. There are very, very few options left. Those who are holding the negative debt have to, and they have to either because they're trying to hedge their balance sheets or because they have options that are quite constrained. Another possibility is that they might expect bond yields to go further down and to sell before others do. Now, it's clear, therefore, that very, very low interest rates encourage risk-taking. There is a fine line between risk-taking, welcome risk-taking, and excessive risk-taking, because excessive risk-taking can generate financial vulnerabilities. Now, of course, central banks are fully aware of this. It is indeed a delicate trade-off. On the one hand, you have to support the economy. The economy does need support and will continue to need support. The outlook is rather uncertain, and you would rather err on the side of doing too much as opposed to doing too little. That indeed has as a possible side effect a certain amount of risk-taking, and central banks have to navigate these tricky waters and are doing the best out of it.
Thank you very much. The next question comes from Marcus Fruhoff from FATS, and he asks two questions, I suppose. One is, should banks not pay dividends? And looking at also at credit risks and NPLs, is a new banking crisis possible? So a two-part question. So I'll hand over maybe to Claudio with that, and then maybe Hyun might support it.
As I said earlier, banks went into this crisis with very, very strong balance sheets. And that has allowed the authorities to get them to lend and support the economy, which I think is quite exceptional and extremely welcome. Now, if you want banks to play that role, a cushion for the system as a whole, then you have to try and make sure that they have as many resources as possible. So on the one hand, the authorities are using all the flexibility that they have at their disposal in terms of regulatory and supervisory tools in order to encourage banks to lend. But then, on the other hand, the quid pro quo for this is to ensure that banks have as many resources as possible, and that also means restraining dividends. Yes, of course, at least in the short term, shareholders may not be very pleased with that. But you have to take a broader perspective. First of all, on the other hand, creditors will be better supported, better protected, and therefore the overall impact on the cost of funds for the banks is ambiguous, at least a priori. Secondly, if banks were to have more serious problems, then also shareholders would suffer. So all banks are doing is effectively retaining dividends now, but they will be able to pay them out in the future. As far as possible stress in the banking system is concerned, the authorities have carried out quite a number of stress tests, and they in general suggest that the banking system is in a good position. They are also encouraging banks to price risk very carefully, and I think this augurs well for the future. But everything will depend very much on the evolution of the pandemic. The second question was about...
What did I cover? It was about both? NPLs and credit risk arising.
Yeah. Yes, indeed. As I mentioned, banks have been encouraged also by the authorities to price credit risk very carefully. And that is indeed what they should do. They should also recognize any losses that might be in their balance sheets as soon as possible. And that is indeed the right thing to do.
We have another question from Ignacio. I'm just trying to see his surname. He's from El País. Ignacio Frariza, who asks, what risks do we see from this asynchrony between the stock markets and the real economy?
As I mentioned at the beginning, overstretched valuations are a source of potential vulnerability in the system, which is why authorities are looking at this issue very, very closely. In terms of what might happen in the future, this is indeed just a vulnerability and very much will depend on the future evolution of the pandemic, of the containment measures, and therefore on the impact on the macroeconomy.
Thank you very much. So at the moment, we can't see any other questions coming in. A reminder, raise your hands, send the question to chat, or email press@bis.org. If there are no major questions on the overview, maybe we can go to questions then on the features. So we can also take your questions on the features now. We'll pause for a moment. I'm getting a signal that there's another one on the way, so I can see it. Aha. Thank you very much. Oh. So excuse while we just take a look at this one. Okay, so the question is from Natalie Olaf Ors. One of the issues examined in the special features is the efficiency of central bank support at a time of crisis. With the pandemic, central banks have launched large-scale interventions to stabilise the economy, but going ahead, will the central bank still have powder to help support the economy? With the risks of worsening economic outlook, with possibly a wave of default, in particular from small, I'm just reading this from small, sorry, I cannot see the writing on it, sorry. Yeah, from small and medium-sized businesses, what will be the tools for central banks? So, apologies, that was a bit hard to read. Thank you for your question. So, what will be the tools available to central banks?
Maybe.
I think we might start with yourself, Claudio.
Okay.
Yeah.
First point, central banks have not run out of ammunition. All you need to do is to look at the big impact that their actions have had on financial markets that we were actually discussing before. Moreover, if you look at the expenditure components that have been holding up the economy, quite a number of them have been particularly interest sensitive, which is a sign that monetary policy is working effectively. As regards the solvency phase of the crisis, which we are transitioning to, the heavy lifting has to be done by the government. What central banks can do, and the only thing they can do, is basically to support the economy by keeping accommodative financial conditions. As people like to say, indeed, as Chairman Powell has said, central banks can lend, but they cannot spend. The only public agent that can spend, of course, is the government. And there the task of the government will be to help distinguish those firms that are viable from those that are non-viable, to provide more targeted support, and therefore to allow markets also to facilitate the market's signals that would allow resources to move from less productive to more productive sectors. And let me stress there that, again, the role of banks is very important, because if you have strong banks, they will be able to support the necessary reallocation process.
Thank you, Claudio. Kyun, do you want to come in on that question?
No, it's okay. I think that was pretty,
okay.
That covered all the bases.
Great, okay. The next question is from Pat Mencheski. Are you seeing some reluctance to pursue bank credit among borrowers in Southern European and other economies where economies are weaker, as compared with the debt market borrowing? And he asks, do we see anything especially amongst SMEs? I mean, Hyun, do you think we give you that question?
That's a question that's not covered in particular in this quarter review, but I can certainly offer you some findings from other studies that we've done. I would point you to a study that we published. Well, actually, 3 studies. There was a bulletin. There was a BIS bulletin piece that we published in August by Tirupam Goel and Jose Maria Serena. And there, the finding is that there is a very big contrast between the access to capital markets by very large firms and the access to markets that entail some form of bank intervention. So I think the message there is large firms do very well. So the mega firms do very well, the rest less well. As always, it's the small and medium-sized enterprises that that experience the highest hurdles to accessing credit. And there, I think we can learn from previous experiences of how this transition from the liquidity phase to the solvency phase have gone. And there were these 2 bulletin pieces in September that looked at the time lag between the onset of an economic slowdown with the manifestations of the bad debts, and that typically takes a fairly long time, and I think that it does suggest that we need to keep an especially close eye on this problem.
Thank you, Hyun. So we'll pause again to see if there are any more questions or raised hands. We'll wait, we're not seeing any other questions, raised hands. Looking around the room and on the screen, we'll just give you another moment in case. We are, as always, at your disposal to answer questions afterwards on the special features as well, and authors happy to brief you as well. So I suppose, given we've given some time and no other questions coming in, we want to thank you very much for your time today. There's plenty of reading material between all the features and the overview itself available, so you can access it all now. Reminder that the embargo is 1 o'clock Central European time today, and we're always at your disposal to answer the questions. So thank you very much for your time. If we don't speak to you before the end of the season, we wish you a very good and restful and safe, peaceful Christmas season, and we'll see you in the new year. Take care, and thank you, everybody. Thank you, Hyun. Thank you, Claudio.
Thanks, everyone. Thank you.
Thank you.